LoanDepot stock, ticker symbol LDI, had another tough session on Monday. The shares fell by 23 cents to close at just $3.49 per share. That's a decline of about 6% in a single day, extending what's been a painful slide after the stock looked like it might be the next retail favorite only a few weeks ago. So, what's going on here? Did something fundamentally change at LoanDepot? Was there new negative news that spooked investors? Or was this sell-off more about technical breakdowns, insider selling, and fragile sentiment? The short answer is that Monday's move looks less about new fundamentals and more about psychology and technical signals. When you mix in ongoing insider sales, weak buy-side support, and negative analyst sentiment, you get the perfect recipe for a sharp decline. Let's unpack it. First, the technical picture. Technical analysis may sound like voodoo to some, but it matters because so many traders use it to set stop losses and trading strategies. In LDI's case, several bearish signals had already been flashing in recent sessions. Analysts tracking momentum indicators noted a MACD death cross forming. That's when the shorter-term moving average crosses below the longer-term one, often taken as a bearish momentum shift. Other indicators like KDJ also showed weakening momentum. When traders see those signals, they act defensively. They tighten stop-loss orders, or they bail out entirely. And once key price levels are broken, those stop-loss orders trigger in waves. That's how you get a cascade of selling. On Monday, that seems to have been a big driver. The stock broke through support levels, and with limited bid-side strength in the order book, each sale pushed the price lower, creating a snowball effect. This isn't unique to LoanDepot. You see it with any small-cap momentum stock. But it's particularly brutal here because so much of the recent LDI rally was built on sentiment rather than institutional conviction. When retail sentiment wavers and technicals crack, there's no safety net. Second, insider selling. If technicals set the stage, insider activity set the mood. Over the past several months, insiders at LoanDepot have been steadily selling shares. CEO Anthony Hsieh has sold, other executives like Jeff Walsh have sold, and filings show additional planned sales. Most recently, Dan Binowitz filed a Form 144 to sell another 50,000 shares, on top of nearly 500,000 already sold in prior weeks. Now, to be fair, not all insider selling is a red flag. Some of these sales are part of prearranged trading plans known as 10b5-1 programs. Others are related to restricted stock vesting, meaning executives are essentially cashing out compensation rather than dumping long-held personal shares. That context matters. But for retail investors, optics matter more. And the optics here are simple. Insiders are selling while the stock is under pressure. Meanwhile, at a peer company like Opendoor, insiders are actually buying stock. That contrast couldn't be more stark. Retail traders interpret insider selling as management doesn't believe in the stock. They interpret insider buying as management is confident. It may not be that simple in reality, but perception drives price in the short term. So when you combine bearish technicals with headlines about insider selling, retail confidence crumbles fast. Third, analyst sentiment. LoanDepot isn't exactly a Wall Street darling. In fact, the consensus rating on the stock remains in sell territory among many analysts. Price targets are often below where the stock has been trading recently, suggesting analysts think it's overvalued even after the pullback. That doesn't help. Remember, a lot of LDI's momentum came from retail excitement around Citron Research's bullish call. Citron argued that LoanDepot's mortgage servicing portfolio alone was worth $5.50 a share. That gave traders a target to latch onto, and it fueled a retail wave of buying. But traditional analysts don't share that bullish view. They continue to emphasize risks, ongoing unprofitability, sensitivity to mortgage rates, and housing affordability challenges. When the analyst consensus is skeptical and the retail narrative loses steam, the path of least resistance is down. Monday's drop is a perfect example. Fourth, the absence of positive news. It's not just that there was insider selling and weak technicals. It's also that there wasn't anything positive to offset those negatives. No new earnings report, no bullish guidance, no big refinancing volume update. Even at the macro level, there wasn't much to cheer. Bond yields have been choppy, mortgage rates remain sticky, and rate cut optimism doesn't always translate into immediate mortgage demand. Without fresh good news, the stock was left vulnerable. So, to recap, Monday's 6% slide was driven by a mix of technical breakdowns, insider selling optics, negative analyst sentiment, and a lack of offsetting positive catalysts. But does this mean the LDI story is over? Was the popularity around this stock just a flash in the pan? Not necessarily. Let's remember why people got excited in the first place. Citron highlighted the servicing portfolio, estimating its value at $5.50 a share. LoanDepot's most recent quarterly results showed narrowing losses, stronger margins, and $409 million in cash. Anthony Hsieh is back in the CEO seat, providing leadership stability. And with the Fed cutting rates, 25 basis points so far, with 75 more possible this year, the macro environment should be improving for mortgage lenders. Those factors haven't gone away. The fundamentals are still there. What's changed is sentiment. And sentiment can swing back, just as it swung against the stock this week. So, what's the big picture takeaway? Here are 3 key points. First, insider selling doesn't necessarily mean doom. Yes, it hurts perception, but some of these sales are pre-planned or compensation-related. The bigger issue is the lack of insider buying. If management wants to signal confidence, they need to put money back in. Until then, retail investors will remain cautious. Second, technical breakdowns don't last forever. Once the selling cascade is done and support levels are found, momentum can reset. For traders, the key is to watch whether LDI can stabilize around the mid-$3 range or if it breaks lower. Third, the fundamentals are still improving. LoanDepot is not profitable yet, but it's moving in the right direction. If the Fed continues cutting and mortgage activity picks up, the company could benefit. That makes this current weakness more of a sentiment reset than a fundamental collapse. So, what could this mean for investors? For short-term traders, it means expect more volatility. If you're trading based on technicals, you'll want to watch momentum indicators closely and set tight stop losses. For long-term investors, it means separating noise from signal. The noise is insider headlines and daily price swings. The signal is whether LoanDepot continues to strengthen financially and whether the housing market gets a lift from lower rates. Could LDI be a flash in the pan? It's possible. The hype from Citron's call and Reddit chatter may not be sustainable. But could it also be a misunderstood asset with real hidden value? That's possible too. The next few quarters will be key in determining which narrative wins out. Let's wrap this up with what to watch next. First, insider activity. If we finally see an insider buy stock, even a modest amount, that could shift sentiment quickly. If insider sales continue without any buying, the perception problem will linger. Second, mortgage rates and bond yields. If long-term yields decline and mortgage rates follow, LoanDepot could see an uptick in origination and refinancing demand. If mortgage rates stay sticky, the benefits of Fed cuts will be muted. Third, the company's execution. Investors should watch quarterly results for evidence that losses are narrowing further, that margins are strengthening, and that the servicing portfolio is generating steady income. Execution matters more than hype in the long run. So, to answer the question, why did LDI crash 6% on Monday? The answer is less about a new crisis and more about fragile sentiment breaking down. Technical signals turned bearish, insider selling scared retail traders, analysts remained negative, and no positive news stepped in to save the day. That's the recipe for a decline. But this doesn't have to be the end of the story. LoanDepot still has a case to make. If fundamentals continue improving and the macro environment turns in its favor, today's pain could set up tomorrow's opportunity. For now, though, the message is clear: popularity alone won't sustain a stock. It has to be backed up by confidence, execution, and signals from management. Until LoanDepot can provide that, expect volatility to continue.